Hello, this is Sergio Morero, and we're here with another episode of RBL1 Live. We have an amazing investor and founder today, Alisha Griffey, who is CEO and founder of Daintree Capital. Thanks for joining us today, Alisha.
Happy to be here. Thanks so much for having me.
Yeah, excited. So for people that don't know about Alisha's background, she has a long history as an operator in the startup space, but has a graduate of University of Virginia, has her MBA from Stanford University, and now is CEO and founder of Daintree Capital, elevating founders, particularly female founders. But turning it over to you, if you can share with the audience, what is Daintree Capital?
Sure, I'm happy to do that. So Daintree, the best way to explain it is to share a little bit about my background because it helps explain what I'm doing. As Sergio mentioned, I have been an operator in the startup space for over a decade, always in COO or CFO roles, helping to build, grow, scale, sell startups, mostly in the clean energy space, but also in healthcare. And after doing that for a decade, I had a lot of experience raising money and going through exits, begging investors for money. And so I had my own opinions about what was working and what wasn't working in terms of how capital flowed to startups. And so 2 years ago, I decided to move to the investor side of the table. And I did so with a very specific goal in mind. And that was because I had seen firsthand how in my view, the flow of capital was broken when you have less than 3% of venture capital dollars flowing to female-led companies. You either believe that men have 97% of the best new business ideas, or you believe that something's not working right in the way that we fund companies. And so obviously I believe the latter, and I wanted to help do something to change it. And so I founded Daintree with not just the focus on women and other underrepresented founders, but also with kind of two other things I wanted to address. One is that I saw in my experience on the operator side of the table, I kept seeing lots of companies with great core economics. They were doing interesting things. They had great economic fundamentals, but maybe they weren't growing at the hyper rates that venture capitalists were looking for. And they kept getting overlooked. So I wanted to figure out a way to invest in these, as often are dubbed now, zebra companies versus unicorn companies. So that was one thing. And then the other thing was, if you looked at the statistics, women found companies at the same rate as men, but they don't get them over the $1 million revenue hurdle at the same rate as men. So I wanted to help fund companies that were right on the cusp of that $1 million revenue hurdle, where I knew if we could get them over that, there would be a lot of other investment opportunities for them. So I founded Daintree with kind of that triple focus. So female founders, other underrepresented founders is one leg of the stool. The second leg of the stool is focusing on using debt as the tool because it allows me to invest in companies that have strong core economics, but maybe aren't growing at crazy hyper rates. And then three is focusing on companies that are in the 100,000 to $1 million revenue range, and focusing there in hopes of helping to get them over that $1 million revenue hurdle where a lot of other capital options open up.
That's great. I'm glad you're here sharing more about Daintree and then also talking about alternatives to capital that's out there. Everyone focuses on venture capital, which you can largely say is anything going into startups, but they view it as traditional. You give dollars and you get a slice of equity for the company. How can you share a little bit with the audience about the debt investing and how it works? Is it just a convertible note or is it a different arrangement?
Sure.
and yeah,
I don't do convertible notes. And the reason for that is convertible notes are really just equity disguised as debt, right? You do convertible notes because it's an easier way to raise money. And the hope is always from the investor side that it converts to equity. And so the bet the investor is making is still an equity bet. They're still betting that this company is going to be successful and that note will convert and that they will get equity returns on that investment. So what I'm doing is much more traditional loans in terms of principal and interest loans. But what makes them different is the way you evaluate a company. If you're investing from an equity perspective, what you're often looking for is a 10x return. And you have to do that because you're taking these early stage companies that are often high risk and you're building up, a bundle of companies, a portfolio, and you need some of those companies to have these kind of crazy outsized returns to compensate for all the companies that don't make it. So basically every company ends up having to promise 10x returns. And then the investors invest and some of them achieve it and a lot of them don't, but that the bundle of companies will get the investor those kind of equity returns they're looking for. The debt approach is very different because when I look at a company, I don't need to necessarily believe that I'm going to get a 10x return. And I don't need to believe that it's going to be $1 billion company in 5 years. And I don't have to believe that it has a TAM that, is the size of the ocean. What I do need to believe is that they have a strong enough business model and they are well run enough that they're able to generate enough cash to make monthly debt payments. So it's a very different calculus. So what I look for in the companies I invest in is I focus really on unit economics. And by that, I mean, what does it cost to sell one unit of the product or one unit of the service? And what are the revenues from that one unit? What are the margins associated with it? So what is that core business that I'm investing in? What are the unit economics? What are the margins of that core business? And if the margins of that core business are really strong, and if they have a growth investment they're looking to make, and there's sufficient track record in terms of revenues, then it starts to become believable that they can make a debt payment. So it's a pretty easy calculus. I look at their financials and I look at, the historic cash flows and I say, hey, can we insert a debt payment in here? And is it believable that they could make that monthly debt payment? And if it's believable they can make that monthly debt payment, and in general, I think it's an interesting company, and in general, I think it's a talented founder, then I do a working capital loan. And those working capital loans are often used for really basic things like inventory financing for product companies. Sometimes it's equipment purchase. Sometimes it is for service companies, it might be geography expansion. It might be investing in advertising against a product that already has a lot of traction or a service that has a lot of traction, but maybe you haven't invested in advertising. So those are the kinds of kind of working capital projects that I invest in. And then each of those has to be closely enough tied to generating revenue that it's believable that they'll then be able to make the monthly debt payments.
Excellent. Yeah, and in a number of founders that we've talked to, excellent founders, right? They may be doing more product-based companies rather than high-tech, technology, high growth startups where they need that working capital. It's a great alternative to whether it be the traditional debt or doing revenue share, right? Revenue-based financing or whatnot. So great to hear about the alternative. I think we need more people providing alternatives rather than just venture.
We need more options, right? Because venture capital is a fantastic solution to a small sliver of the companies that are out there. And it's a great fit for some of them. But the problem is, I think a lot of founders assume that it is the only way or it's the best way to raise capital. And I think it is a great way to raise capital for a subset of these startups. And for a lot of the startups, it's not a good fit. And so what we need more creativity, we need more innovation in the financing tools we use so that you have lots of different options as a founder and you can make different choices depending on what you're doing. And there may be times when debt's the right tool. There may be times when revenue-based financing is the right tool. There may be times when a structured equity agreement is the right tool. And there's certainly times when venture capital is the right tool. But assuming that there's one solution that works for all companies, I think is a huge mistake. And I think it ends up pushing founders to make promises that may not be appropriate for the business they're running. So that's why I like to be in the space where I'm kind of adding a different financing solution to the toolkit. And I look for companies that maybe are in a slightly different place than the companies that Silicon Valley's chasing.
Love it. And this sounds like a theme I'm hearing from individuals that have been founders before, and you have. So I wanted to call that out. And if you can share a little bit more with the audience, if you can walk us through your journey as a founder. I know you know back at in your undergrad you studied economics, but what can you share with the audience a little bit of what led you to be a founder and then now be an investor?
Yeah. So I spent a decade on the operator side. I was never actually a founder, but I was always one of the very first employees. I was COO, CFO. I was always brought on very early. I was employee one at one of the companies, and very, very early in all of them. And my job was always to build and scale the finance team, and to build and scale internal operations to support rapid growth. I was involved in doing angel financing, raising small, $1.5 million angel rounds in companies that were, really tight with money and had been bootstrapped, and then did a small round and were very, very careful in how they spent every dollar, all the way up to another company. I was brought on to help scale quickly because they had strategic investors from day one and $20 million in the banks on day one. So they had kind of rocket fuel and were ready to go. And we had to build out a finance team and internal operations that supported crazy rapid growth. We went from no employees to over 2,000 employees in 4 years. We also climbed to 200 million in revenue, and we IPO'd. So it was kind of the crazy hyper growth situation. And in that scenario, we took private equity money, we took venture capital money. We also ended up IPOing. And so across all those different experiences, what I saw is there's pros and cons to different types of investments, and there's pros and cons to different check sizes. And I think the assumption incorrectly is often the bigger the check, the better, the more money, the better. And what happens when you have a lot of money is you very quickly have to chase crazy big growth goals and expectations that are set by those investors who want to get a huge return on that investment. And so I kind of saw some of the downsides to that, and the fact that it really does require you to swing for the fences. It requires you to chase hypergrowth, requires you to kind of work at a speed that triggers a lot of burnout. And I'm not saying it's always bad, and I'm not saying it's always wrong. I think there's a time and a place for it. But I do think that there's a downside to it. And so that experience, growing so crazy fast with some of these companies, really triggered me to think about, well, what does it look like if we grow a bit more slowly and we really focus a bit more on sustainability of the business model we're growing, and we focus more on the founder continuing to have ownership stake, a significant ownership stake, versus being diluted out in every round. And so it's a different way to think. The people who get a lot of the press are the ones who have huge valuations. But if you have $1 billion valuation and you own 1% of the company, it's very different algorithm. It's a different situation than if you run, what if you're running a $300 million company with 30% margins and you still own 60% of it because you didn't have to take on so much equity and get diluted. well, why isn't that success? Why isn't it success to be running these, multi-million-dollar companies with strong margins, and you are the majority owner, or the management team is the majority owner? And those kinds of companies, I think, are really just very interesting to me. So that's what I've ended up designing Daintree around.
That's great. And what has led you as your experience as a CFO and executive leadership? Can you share more around where did you make the shift to focus on underrepresented founders, and particularly female founders?
Yeah. So, you always have this trick, right? When you analyze the world, you try and figure out, is my experience generalizable or not? Is what I'm experiencing the same for everyone? And so, in my experience, I was almost always the only woman in the room. I was almost always the only woman on the management team. I was almost always the only woman in the boardroom, presenting in all the different funding rounds I raised, whether it was from angels or it was from venture capital or it was from private equity. There was never a woman on the other side of the table cutting a check. And so after a decade of doing this, I kind of was thinking about it. I was like, well, is this just the happenstance of my experience? Is this the industry I'm in? What is driving this? And so I started looking at some of the data, and I thought, gosh, in my experience, it's really rare to have women, driving the decisions and building these companies. And it's really rare to have them writing the checks. But I thought, gosh, it's probably like 70-30 or 80-20 in terms of gender divide. And then I looked at the statistics, and they were so much worse than I thought. I thought it was bad. And then I looked at the statistics, and, less than 3% of venture capital is going to female-led companies. Fewer than 9% of the venture capital decision makers, the partners at venture capital companies, are women. The statistics were so much worse than I had even assumed, that once I saw that, I was like, okay, I have to do something. Like this isn't, I can't look away from this problem. It's even worse than I thought. And to be honest, it was a pretty easy jump to make, because it doesn't feel hard to get behind a bet that says, are women responsible for more than 3% of the best new business ideas? Are people of color responsible for more than 5% of the best new business ideas? It's just not hard to get confident that that's a great bet to make. And my personal view is, until CEOs look like the face of America, there's huge opportunity for us to be putting more and more investment capital towards these underrepresented founders, and that it's both good for investors, and it's also great to be hopefully making more progress towards helping money flow in the way it should have always been flowing.
Yeah, and it's true. I mean, even in the past year, with all the focus on underrepresented founders and female founders, the amount of funding toward female founders really hasn't moved all that much.
Actually got worse in 2020.
It got worse. It's like about 2%. It went down for early stage ventures, went up in later stage ventures, which like you can say that's like later in the life cycle. But even so, like what there's something wrong there. So the question is, how do we really level the playing field, and not an incremental way, but in a a step function? What are different things that we can do? Alternative business models, and Daintree Capital is one. But if you have any other ideas for the audience.
Well, I think there's also, in my view, so much about the problem relates to who's making decisions. And part of why companies aren't getting invested in that are being run by women or run by people of color is because the people who are making decisions on the investor side are disproportionately, it's lopsided, right? And you don't have women and people of color making the investor decide decisions. And until we solve the investor side, we're going to always be playing catch up on the founder side. So I think that issue of diversity in founders and diversity investors are inextricably linked. And so for me, I get excited when I start seeing innovation that is happening on the investor side too. Some of the new changes in SEC rules about accredited investors, some of the new things that are happening in terms of, crowdfunding and some of the things that, like Backstage Capital is doing, and all these different companies that are getting really creative about getting more people involved on the investor side and getting involved at smaller check sizes. When all of a sudden you can invest at $500 or $1,000 versus, it used to be, to be an angel, you need to be able to write a $25,000 check. Well, I think it's really exciting when you have more people involved, because the more people who are involved, the more likelihood there is that that pool of people is a better reflective of the country we live in. And once that starts happening, I think you start getting more money flowing towards founders who, look like all the rest of us, versus look just like the decision makers historically in Silicon Valley.
Absolutely. I think there's so much there. One of the aspects in terms of supporting early stage female founders, like you said the decision makers, there's different ways to get capital. Are there other organizations or entities that you would point to that you feel are doing a great job at supporting the ecosystem? An example I can throw in there is like X Factor Ventures, right? I don't know if you probably know them, a network of female leaders and operators that are doing a collaborative investment, which is really powerful. So love highlighting these different areas. Would love to hear from you on that.
Sure. So there's a bunch of them, but one I would most certainly mention is an organization called SheEO, and they have a really interesting model, because what they do is they basically crowdsource money that is all put into a nonprofit. So it's a tax deductible donation that you make. I think it's $1,100 in the US. And once you make that donation, all of the funds are pooled. And then everyone who's made that donation is part of a screening process and a voting process that's democratically done, that selects 5 female founders every year in each of the countries within which they operate. And those 5 founders get a $100,000 loan. It's an interest-free loan. These are nonprofit loans. What I really love about the organization is there's low barriers to entry. So first of all, it's $1,000. It's not $15,000. It's also technically a donation. So it opens up charitable funds, which may come from a different part of people's budgets. And then once you're a part of that community, what's great is it really then does a fantastic job of focusing on these founders and what do they need, and are there things that the people in the SheEO community can provide to them to be helpful beyond just money? So are there connections? Is there expertise someone can lend? It does a great job of really building that community and helping what they call ask gives. What are the asks some of the founders have? What are the gives some of the what they call activators have, who can help these founders and help each other? And so I think that community is really a strong one. And there's some fantastic companies that have come out of that program. And there's also just a really great, strong community of participants that has sprung from that idea as well.
Yeah, I'm excited to see the continued theme of community investment in different ways. Also, you are based in Washington, D.C. Many individuals, when they think of startups and funding, we think of the New Yorks, the San Franciscos, maybe even Boston. But wanted to ask you a little bit about why you chose D.C., what's unique about D.C., and why did you place Daintree there?
So my answer is relatively boring in that Daintree's here because I'm here, and I'm here for family reasons. That said, DC is an interesting startup community in that there's a lot, particularly in the biotech space in the DC area because of NIH. So there's a lot going on in terms of biotech, and there's also a ton of tech companies that actually spawned out of AOL years ago. And so there's more going on in DC in the startup scene than I think a lot of people realize. That said, I am geography agnostic other than being focused on the US market. So I will invest in any company that has a US presence. And certainly within DC, it's kind of fun to get to know the founders who are here local, and it's easier to build community. But I am in no way geography bound. In fact, I actually think there's huge opportunity to be investing in companies that are not in the startup hotspots. I think the whole idea of like the Rise of the Rest Fund is really interesting to me because I think there are a lot of cool companies happening in Middle America or happening in smaller cities that aren't traditionally don't have great access to Silicon Valley investors. And I think that's where there's a huge opportunity for us as investors to focus our time and effort because there's even more need for that investment capital.
Excellent. I used to live in Washington D.C. Amazing place. Love the startup ethos. I feel is unique. I don't know if you find it the same because there's this very purpose driven, not just to start a company, but to to change the world a little bit idealistic. But it's a great ethos there. For the audience, I know we're coming close on time. Can you share a little bit more of what's next for Daintree Capital?
Yeah, so Daintree, like I said, is relatively new. So we started in the early 2020, January 2020, and that 2020 was our first year. We did 14 investments, really was proving out the investment thesis. We're at a point where I'm proud to say we've got all of our loans are in good standing, which is fantastic. So 2021 is really about how do we scale the idea. So that's, the main focus for me across this year is how do I build this idea into something that is way bigger than what I can personally fund? And how do I scale it in a way that is going to allow us to have a lot more impact than we can have, just by being something I'm doing. I want to be able to figure out a way to let a lot of other people participate in this idea and increase the flow of capital significantly. So that's the focus for 2021.
Amazing. Thank you very much, Alisha, for joining us tonight. So everybody who's tuning in, this was the RBL1 Live, Alisha Griffey, who is founder and CEO of Daintree Capital, hailing from DC. Thank you for joining us tonight, and tune in to our next episode here on Thursday. And thank you for joining the Rebels tonight. So thank you, Alisha.